All right, good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to the stock buying secret that beats 80% of the pros. Our presenter today is Sandy Chaikin, co-founder of Chaikin Analytics. Throughout our presentation, please submit your questions using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. Michelle Greenblatt and I will be available to respond to your questions. Now, this webinar is being recorded, and we'll be sending a copy of this to everyone who has registered. Now, a bit about Sandy. With no prior experience, Sandy started trading in 2012 with Chaikin Analytics and built a killer portfolio that outperforms the S&P 500 and most money managers. Sandy is living proof that you do not have to be a financial expert to pick winning stocks. She presents webinars and speaks at industry events on fearless investing by following the Chaikin 5-step method. Sandy is a contributor to NASDAQ.com, where she also hosts webinars on investing. Now, prior to co-founding Chaikin Analytics, Sandy had her own marketing and communications firm in a career that spanned over 30 years. She's held senior management roles for Elizabeth Arden, L'Oreal, and the Franklin Mint. She is a member of Elevate, a global professional women's network and Women in Investing Network of Philadelphia. Now, to get us started, I'll turn it over to Sandy Chaikin.
Joe, thank you so much, and thank you all for attending today's session. So as Joe said in his introduction, I started investing in stocks in 2012, and since that time have consistently beaten the S&P 500 and 80% of the money managers in this country. So the point I'm making is that you don't have to be an expert, as Joe said. You don't have to be an expert and be spending decades of time and hours of research to be a better investor or to even learn how to invest. But that's what the point of today's session is all about, is that how I do it. I use examples from my own portfolio, and I walk you through my thinking of how I found the stock, why I wanted to buy it, when I bought it, and when I sold it. So it's not as complicated as a lot of people would make you think. And if I can do it, you can do it too. So another little secret is that I didn't start investing in stocks until after I was age 60. So you're never too late. It's never too late in the game to learn. Okay, so let's get started. I first need to get this legalese out of the way. To recap this disclaimer, we are not registered with the SEC or with any state authority on being able to recommend the purchase or advise on the suitability of any trade or investment. What I'm going to be presenting today is strictly research and is not to be construed as an endorsement, recommendation, advice, or any offer to buy or sell, but solely as research and information requiring further research from you as to whether it's appropriate for you or not. Users bear sole responsibility for their own investment research and decisions. Okay, so let's start this hour off with kind of framing where we are as investors. And the scenario isn't too positive here, in that the S&P on average has grown about 10% a year over the last 20 years. Yet the research shows that individual investors have only averaged 2.5% because people buy on emotion, not fact. And that's why it's so imperative to have a disciplined methodology, and a methodology that is proven and that you have confidence in and can use it time and time again. And that's basically what I'm going to be sharing with you today. The actively managed mutual funds performance isn't really much better. 81% have underperformed the S&P, and that goes back for the last 10 or 13 years. So investing in mutual funds is not really going to help your returns out either. And on top of that, mutual funds do charge fees, management fees that you have to pay. So our solution is what we call bullish rated stocks. Now, these are stocks that I owned in 2016. You can see the performance here is pretty stellar. Of the 8 or 10 stocks at any given time that I own, these 5 have, for the most part, triple-digit gains. They go from 61% gain to 189% gain. And you compare that to the S&P 500, which is the barometer against which most of us measure our success. And the S&P was up 10%. So I imagine the reason you're on this webinar today is because you want to see these outsized returns yourself. If you were satisfied with average returns, you would put it into an S&P 500 index fund and get 10%, which is better than the 2.5% that individual investors have averaged. But in today's webinar, we're going to talk about how you get these outsized returns. So my promise to you is you're about to discover my secret to how I beat the pros and how I find winning stocks quickly and easily. Because like most of you, I work full time. So I don't have all day long to basically monitor my portfolio. I can manage this very, very efficiently in 10 to 15 minutes a day. That's no exaggeration. All right, so what's the point of us investing in the stock market? So for most of us, we have multiple reasons. One, to save for retirement, but kind of the more immediate and fun part of it is to have money that you can use to celebrate and do things that you want to do with it, or buy things that you want to buy with it. So what Mark and I have done over the last several years since I started investing is to take some of my returns and put that towards a trip. A couple of years ago, we went to Turkey, and that was solely on the return of one stock, and that was Southwest Air. A couple of years ago, we went out to Vail to the Performing Arts Festival, and last year we went to Rome in the spring. All of these trips were paid for by my winnings. So think about how you want to celebrate, and put that in the back of your mind, because I really make this fun. It's really become a very fun exercise for me to invest in stocks. And part of the fun too is to save for that future trip or future car, or whatever it is that you would like to have. All right, so why should you listen to me? Well, as the title suggests, I've beaten the S&P 500 ever since I started investing in 2012. And because the research shows that 4 out of 5 pros underperform the S&P, by relationship, I thus beat 4 out of 5 pros, or 80% of the pros. Started investing just in 2012. I started with stocks that I knew of, like eBay, Comcast, Yahoo. Big wins in Southwest Air and Skyworks over the last several years. And then I started getting into small cap stocks because they started to outperform the mid and larger cap stocks. And then I found such little, I call them hidden winners, American Woodmark, Activision, both up over 90%. And as recently as this past year, I was in more hidden winners, Centa, Quad, NACO. These are all up over 100%, as high as 189%, as you can see there for Quad. So think about how you would like to be in those stocks. And even though we've never heard of them, and I certainly never heard of them until I found them, these were great stocks to be in. So it doesn't necessarily mean you've got to stick with, the Procter and Gamble's and General Motors and stuff like that you know of. Sometimes the best opportunities are in stocks that we've never heard of. So let me just take a step back here and start with how I started investing in the first place. When I worked for Elizabeth Arden and L'Oreal when I lived in New York in the 70s and 80s, they had 401k plans. And I took the maximum amount that I could, which was 6% of the time, and stashed it away into the 401k plan. They offered a choice of mutual funds. There were about 4 or 5 mutual funds that we could choose from, and I started investing that way in mutual funds. When I went on to the Franklin Mint, I rolled over my 401k plan into their plan, and they too had a choice of mutual funds, and so I invested in those funds as well. And the funds did really well. I was in the Fidelity Magellan fund, arguably really the best mutual fund ever. And Bill Miller on Legg Mason's Value Trust. So I had some really good success with the mutual funds that I chose. But as my career got busier and busier and the fund was growing, I didn't feel confident that I was the one that should be managing this, because I didn't feel like I knew enough about investing. So on the recommendation of a friend, I engaged a wealth manager, and he took my 401k plan and liquidated the funds that I had it in, and then put me in 8 or 10 mutual funds of his choice. And they went along okay for a while, but along comes 2008, and don't have to remind anyone what happened then. But I remember very clearly in the fall, in September of 2008, as the market was, that was actually the day that market first dropped by 500 points, I called him saying, you know, the outlook is not good. It certainly is spiraling downhill. Wouldn't it be a good decision to sell these stocks right now and just not watch them go down? And his advice was, oh no, it's better to ride it out, and they will all come back, and just stay put, stay the course. And because I lacked the confidence to override his decision, I stayed the course over the next 6 months or so, even though I did call repeatedly and say, gee, you know, it's still going down. Don't you think we should bail now? And so the answer was always no. So I suffered a pretty big loss. I paid a very big price for that. My portfolio dropped by 40%. I was totally disillusioned because I felt the advisor wasn't sensitive to my concerns at all. And I was pretty devastated, to be perfectly honest. I'd worked so hard to build that fund up and gave up a lot to put that money, the max amount, into the 401k plan. And then to see it all evaporate by 40% practically overnight was really, really devastating. So I suspect there's a number of you out there who had a similar experience, and could feel the same pain that you see here. Just do me a favor and go into your Q&A box, if you would, and just chat in if you had a similar experience. Okay, so I see Todd says yes, George did, Shondell, Rose, yeah, lots of yeses, unfortunately. So this is not an uncommon theme, but where it left me was that I really felt resolved that I had to take control of this situation, take control of my finances. So what I did was I took the money out of the care of the financial advisor in the like February, I think it was January, February of 2009. And Mark said, why don't you open a Vanguard fund and just put it into an S&P 500 account until you can figure out what to do. And he and I were just getting together then. So I said, that sounds great, I'll do that. So that's what I did. I opened up a Vanguard fund and put the money in there. But the decision that I made from that kind of catalyst, that flashpoint, was that I really needed to take control, and I needed to manage my own money, because after all, nobody cares more about my money than I do. And think about that, you know, it's your money, you've earned it, and you care more about it than anybody else. So even if you are working with a wealth advisor, and we have many wealth advisors who are subscribers of ours, I recommend being involved in the conversation, and being knowledgeable enough to be able to discuss recommendations without just saying, okay, sure, whatever you say, because that's the mistake I did. You know, I wasn't part of the conversation. I just left it entirely in this person's hands, and I paid a heavy price. So it's become a real flashpoint for me to say, you got to take control and do this yourself. So I've now have done that, and it's gone back up over 3 times what it was when I took it over, and I'm in good shape now. But I don't ever want to go through that again. And one of the main reasons I give these presentations is to help investors avoid that pitfall as well. So let me pause again here and ask you what you're facing today. What are the challenges? What's holding you back from pulling that trigger and buying a stock? Or if you own a stock, what's stopping you from selling it? And what's your flashpoint? You know, what's your concern? Are you fearful of losing money? You don't want to get into the market at all because you got burned before? I mean, just if you'll chat into your Q&A, I would appreciate that. Okay, great, thanks. George says, lack of ability to pick good stocks. Jazz Karn said he's got 500,000, afraid of losing that in the market. So fear of loss is a big one. Bad News says stocks are priced too high. Well, they're not all too high. I'll show you. I'll show you how you can still get in. Jackson, I want to triple that or quadruple that in 4 years. Well, you do the best you can. is what I say. Certainly, that's a lofty goal. Todd is concerned about buying while the market is overpriced. Richard is lacking confidence. And Tamara doesn't like losing money. Of course not. We all don't like losing money. But one thing to note here is that losing money is part of the equation. You know, it's impossible to invest in the stock market and not have any losses. So accepting loss is really part of the mindset of a good investor. But what we can do is minimize loss, you know, and that's what I'm going to show you today, how I minimize my losses, how I know when to take a profit, and how I know when to get out before a stock tanks. Okay, so yeah, knowing when to sell and buy, says John. And picking good stocks, says Janet. And a lot of you, I didn't get a chance to get to you, but there's a lot of you more or less saying the same thing. And this is typically what I hear on all of the presentations that I give. Lacking the education and tools. You know, this leads to a lot of why, in addition to trading on emotion, of why individual investors underperform the market as they did last year. Lacking confidence, that's a big one, you know, because if you don't have the confidence, you're not going to make a good decision. It's that simple. Or if you do make a decision, it's likely to be a bad decision. So confidence is key. Fear of loss, that's always a big one. As we heard today, trading on emotion. It's very hard because we're human beings. We're wired with emotions. It's very hard to dewire those emotions and make a trade based on a disciplined approach. But it's possible, and that's you know, that's part of what you need to do as an investor. Timing, when to get in and out. This is always a big one, as I saw today. And information overload. You know, there's so much information out there that we are all inundated with emails and texts and 24-hour news cycles and multiple channels on TV. It's hard to know how to cut through that clutter and make sense of what's important and what's not. All right, so part of my secret is to do just this, find winning stocks in 5 steps. So we're going to go through step by step, and I'll show you how I've mastered this methodology. The examples I'm going to show you are from Chaikin Analytics. It is our workstation that is also on iPad as well as desktop. The desktop charts are what I'm going to be showing you today, but they both come bundled into the same subscription. So why Chaikin? Well, we have a lot of validation by pros, hedge funds here, as you can see, Soros and Paulson, to name a few. And we've been in just about every major financial media channel since we've been in business. Barron's has written this up over 3 times, Mike Hogan's column. to name a few. All right, so trust proven tools. This addresses that concern. Many of you said that you lack the education and you lack the tools. The tools that I'm going to be showing you today that I rely on are based on what we call the Chaikin Power Gauge rating. It's a stock rating that looks at a stock's potential to out or underperform the market over the next 3 to 6 months. Think of it as a GPS for stocks. It tells you where that stock is headed. So it looks very simple here because it gives a simple read, anywhere from very bearish to very bullish. And as you can see, it's in very clear red-green displays. But there's a lot more going on underneath the surface than meets the eye. And all of this is to cut through the clutter, to get you that clear instant read on a stock without spending hours going through research and trying to make head nor tail of finding the research and then analyzing it, putting it all together and coming to a decision. That's what the power gauge does for us. And how this got started is that my husband, Mark, had been on Wall Street for over 40 years, creating tools for institutional investors so that they could make better decisions with their clients' money. They would look at what you see on the right, this reams of data like you see on the right. And from that, they would pull information and then they'd put that information together and figure out a plan, a strategy, an action. What Mark said after the 2008-09 meltdown is he said, he watched me and my despair. And he said, there's like $400 billion that came out of traditional brokerage firms because investors were disillusioned with Wall Street and they canceled out their brokerage contracts and set up self-managed accounts like I did at Fidelity or Vanguard or firms like that. And that's all fine and good, but he said, you don't have the tools and you don't have the knowledge or the information to make good decisions about how to manage your money. And I said, you're absolutely right. He said, well, what I'm going to do is come out of retirement. He had sold his company 10 years prior to a division of Reuters, and he was in retirement. He said, I'm going to come out of retirement and create for individuals like you, Sandy, tools that have the same professional quality as the pros had, but they're going to be in a way that you can understand them. And that's exactly what he did. So you can see the output here on this particular stock example. It's a very clear display, very bullish. What we're saying is that this stock is likely to outperform the market over the next 3 to 6 months. It's headed in the right direction. So what makes up this power gauge rating? Well, there's 20 factors that all go into an algorithm, and they're weighted differently. It took Mark a year or two to work this all out. But he started with over 200 factors, and he whittled it down to the 20 that you see here. And these 20 all go into the algorithm, and they spit out an analysis, a very bullish or a very bearish or a neutral rating on a stock. You can drill down on any of those 4 major components, as you can see on the left, and as are spelled out here: financial metrics, earnings, performance, price volume, or expert opinions. Or you can just look at the overall rating. Or if you really want to drill down, you can drill down on any of the 20 factors. Now, I've highlighted 3 factors here in red because these are the ones that I drill down on. Other than looking at the overall rating, when I'm buying a stock, I just drill down on these 3. So when I'm considering a stock, it needs to be bullish or ideally very bullish. And these 3 factors need also to be bullish or very bullish. So why is that? Well, financial metrics are what a value investor like a Warren Buffett would look like. He's particularly interested in free cash flow. Price to sales ratio, though, has been really useful to me because it guides me really to the value of a stock's revenue. And it's the company's stock price compared to its revenue. And it really indicates the value placed on each dollar of a company's revenue. The expert opinions, I call this our secret sauce, because I'm not sure where you would find this information, like short interest or insider activity elsewhere. Short interest is critical to me because these are the short sellers. They would buy a stock as their initial transaction, and then they sell it, anticipating that stock's going to go down. So I'm sorry, they sell a stock at a certain price, anticipating the stock's going to go down, and then they buy it back when it's lower. If they're shorting the stock, I don't want them to be shorting stocks that I'm looking at, because I look at investing for a longer view. So I want the short interest to be bullish. Insider activity measures insider buying. And why is that important? Well, insiders are only going to buy a stock for one reason, and that's because they think the stock's going to go up. There are many reasons why insiders, or anyone for that matter, might sell stock. That's because they might need to pay, a mortgage or a college education bill or whatever, but they're only going to buy a stock for one reason, and that's because they think that stock's going to go up. And who knows better than insiders? These are typically people in management, so they have access to all of the information and guidance, of where a company is headed. And so I want insiders to be buying a stock that I'm considering buying as well. So here's what it looks like when you drop it down. This is a stock that I own, Progressive Insurance. As you can see here on the far left, very top left corner, it has a very bullish rating. There's a little icon that you can drop it down and get this breakdown. So now I'm looking at the four components, the four major components that make up the power gauge rating. And as you can see, they're mostly very bullish, with the exception of earnings, which is neutral. And then I can drill down even further by clicking on that expert category, and now I see the 5 factors that make up the expert category. And as you can see, short interest and insider activity are very bullish. So this is as good as it gets. And this was the case as well when I bought this stock. I guess it was a month or so ago. But that's what I look for when I'm buying a stock, for those 3 factors to be positive. All right, so we also have news. We've added recently news stories into the stock charts. So at the bottom, you will see a summary of the last 2 news items. By clicking on that news icon, you can get a drop-down menu. And I just did this yesterday on Progressive. And it has an article, stock rating reaffirmed by Wells Fargo. So I thought, well, that's interesting. What do they have to say? Well, it was so confusing. This is the article, but look at just this highlighted part in this little insert we've added on. It talked about the Wells Fargo analysis, or outlook rather, but then it said 3 research analysts have rated the stock with a sell rating, 8 a hold, 3 have given it a buy, and 1 has assigned a strong buy. So does that make sense to you? Who here would know what to do after reading this article? It is so confusing. How would you know what to believe? I mean, this is where I'm talking about information overload and the need to have your own tools. So this is a really good argument for having your own reliable tools that you trust. And that, for me, has been the power gauge rating. The power gauge rating is still very bullish for this particular stock. So I'm going with, the one analyst who's given it a strong buy. The rest I ignore. But you really have to know what is important and what you can ignore, because there's a lot of stuff out there, a lot of so-called, I hate to call it news because it really isn't, but it's opinions and people's subjective opinions about a stock as well, and it's hard to know how to sort through it. But the way I do it is depending on the model, and I think this well-known investor and analyst says it best: models beat human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by emotions and opinions. So the model doesn't have any emotion. It just takes in all the data, it crunches it, and it prints out a finding. And as he says here, it's reliable, it's consistent, because it applies the same criteria time after time. And that is what I base my my decisions on. John Carter, who's a well-known trader and partner of ours, calls the power gauge rating an objective awesome meter for stocks. He likes that it combines technical and fundamental factors. Most models are either technical or fundamental, and they don't combine the two, but our model is unique in that it does include technical and fundamental factors. And John calls this an objective awesome meter for stocks. All right, a little more validation on the power gauge rating. Even though it looks so simple, it is used in the heavy lifting with some of our partners like NASDAQ and First Trust. They have based portfolios on the power gauge rating, and what we've done is we take, for instance, with NASDAQ, we took 3 of their indexes, as you can see here, overlaid the power gauge rating, sorted out the bearish and neutral rated stocks, and left only the bullish rated stocks in the NASDAQ Chaikin index. And those 3 indexes have consistently outperformed their benchmarks for the past 3 years that they've been created by a wide margin. So I hope that's given you a little validation. Is that making sense? Before I go on, I want to make sure, I want to just pause here for a second, just make sure you all are understanding and clear on the power gauge rating, because it is the foundation of what I'm going to be talking about in the rest of these steps here. So if you can just, once again, go into that chat window of yours and just say, all good or clear or yes, I get it, whatever. That would give me the signal to keep going here. Ray's asking if this is a repeat of a past webinar. There are similar parts to my last webinar, Ray, but you will see that I use updated examples. Okay, and I see most of you are saying that you get this, you understand it. Yes, 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 understood, good. Okay, good. All right, so let's move on to what to buy. All right, so this is a pretty simple checklist of what I go through when I'm looking at a stock. I want the power gauge rating to be bullish, certainly want the price trend going up, Chaikin money flow strong, and I'll explain what that means, and relative performance strong, and I'll explain what that means. So let's go to an example here. This is a stock that I bought where this yellow arrow is back in November. So let's break this down into the components that you're looking at here. The very bottom ribbon, right above the months, is the power gauge rating. So what this is saying, excuse me, is that basically since May, the power gauge rating has been bullish on this this bank stock, PEAPACK-GLADSTONE. This little heat map above it is relative strength versus the S&P 500. Remember in the beginning I said I measure myself, as do most investors, against my performance against the S&P 500 index, just as my barometer of how I'm doing. Well, we do that for each individual stock as well. So this heat map here being green is saying that this stock is outperforming the S&P 500. And after all, that's critical. If you're going to get outsized returns, you've got to beat that S&P 500. If you're satisfied with average returns, which have averaged 10% a year for the last 20 years, that's not bad, better than cash. then just go with an S&P 500 index fund. But if you want to outperform the S&P, you want your stock to be green in this relative strength indicator here. Let me skip over overbought, oversold for a second and go up to Chaikin money flow. Now, this was an indicator Mark created some 35 years ago, and it's basically how he made his name on Wall Street. What this does is this measures institutional money coming in and out of a stock. And what took me a while to get used to is the way a stock price moves. It does not move like a retail product, like a cosmetic or a fragrance. I was marketing director for the designer fragrance division at L'Oreal, and whether we sold a bottle of fragrance, say Lagerfeld for Men fragrance, in January or 6 months later in June, the price was still the same. Well, that obviously isn't the same scenario with a stock price. It moves, it fluctuates every day. And a big part of its fluctuation has to do with supply and demand. And supply and demand is measured by money flow. So this has been an incredibly valuable tool for me, money flow. And I'm pretty religious about going with stocks where I see big chunks of money flow coming in, because you can see what happens here. And this is really an interesting study, because power gauge relative strength were outperforming in August, but the money flow was not. And the price went sideways. But when the institutions started buying it, they pumped up demand for it, which pumps up the price. And look what happens. I mean, the price basically takes off. So this little scenario right here, when you look at July and August and September going sideways when money flow is negative, and then when they all three align in September, October, then you really start seeing the price taking off. And that's what I look for. You know, I want all of those indicators, those three indicators we've just gone through, to all line up like this, be green, before I buy a stock. And it's that simple. It doesn't have to get any more complicated than that. Because remember, the power gauge is rolling up 20 factors for me. So I already have 20 factors here plus 2 more. I've got 22 indicators basically telling me that this stock is bullish, indicating that this stock is headed in the right direction and has a good potential to outperform. So I think of it that way. You know, 20 plus 2 is 22 indicators here I'm relying on. And they're all saying the same thing. So that gives me confidence to buy this stock, and that's exactly what I did with this arrow here back in November. These triangles here are buy signals. We have 6 pairs that trigger at different points. This one on PEAPACK triggered was a relative strength buy, as you can see by the header up here. And when that triggered back in here, I had this stock on my watch list, and I got the buy signal. I thought, okay, you know, everything's lining up. I like to see everything lining up for a month or two. I went ahead and bought this stock with confidence, and it's gone up consistently since then. Now, the last week or so, pretty much everything I've had has pretty much gone sideways, but that's okay. That's really how the market has been going, and everything is still green, so I'm fine. There's no thought about selling here at all. I referenced the fact that the stock price doesn't go straight up or straight down, but it does what I call zigzagging. This is a chart created by Dr. Wyckoff some 95 years ago, and he taught stock market investing. And he came up with this, and this is still used today. This is still true today. So to make it easy for me to understand, I really just kind of look at the zigzagging the lines. I try not to read the type here. To me, that kind of gets into Wall Street jargon. But suffice just to say that the stock zigzags, a stock price zigzags. It never goes straight up or down. It goes up a little bit and then sideways and then up a little bit more. And that's a bullish pattern. So think of that Wyckoff pattern when you're looking, well, at PEAPACK here. And then let's move on to National Commerce, which is another bank and thrift stock that I own. So again, let's look at why this is a classic bull. Power gauge rating is green, relative strength, again, money flow, everything lined up come August, as you can see. And you can see once everything lines up, you start getting that price acceleration as well. So again, I had this on a watch list. I bought it with this happened to be an oversold buy signal back in early December. And it's just triggered another oversold buy signal today. So let me pause here to explain what oversold means. And that is this indicator here, the third up from the bottom. And it's just, this is kind of the zigzag pattern. So think of that Wyckoff chart. This pretty much reflects the way the stock moves according to that Wyckoff chart. And this is in real time. So oversold means, or is measured, I guess, by this dip down in here. If you can look just above December when I bought this stock, it's measuring here under this 7, it says 30 on the overbought, oversold. I don't really know what this means or how it was calculated, but I don't need to. I know what it means by looking at it. So when I buy a stock, I want it to be dipping down here, hovering around this 30. And as you can see, that typically dips down with price, especially on an oversold buy signal. For that signal to trigger, it means that stock has to go down for 8 consecutive sessions. And that, when everything else is green, can be a really opportune buying signal, which is what it's telling you today as well. When I sell a stock, I want it to be overbought. I want it to be above the 70 mark on the overbought, oversold, because that then correlates with these peaks up here. And you can see here, there was another oversold buy signal triggering in early January. You can see it dip down, right? And you see it dip down here. Does that make sense? Because this is a really great indicator to help with timing. It's hugely important to identify when to buy and when to sell. So can you see yourself looking at this stock chart and seeing that everything's lining up, and that back early December was a great buying opportunity on that pullback? Is this making sense? If you can just type in, if you would, just yes, makes sense, or something like that. Because as we go through these charts, your eyes will get a little bit more and more used to seeing them each time, and they'll start making a lot more sense. Okay, Bob, Ted, Fran, Oni, Joseph, all saying yes. Okay, great. All right, so let's keep moving here. All right, so how do I find these stocks in the first place? Seeing as most of them are ones we haven't heard of. Never heard of PEAPACK-GLADSTONE or National Commerce. These are not household names. Well, we have what we call a screener, and this screener has been a godsend for me. I'm so excited about this screener because this has saved me an enormous amount of time and really put a filtering system at my fingertips where I can find stocks that meet my criteria literally in seconds. So it's not a very sexy looking tool here, but it's on the workstation, and by clicking on it, I can go to my saved list, which I call Sandy's, criteria bullish, and I can plug in my criteria. So the first thing under Stock Universe that I plug in, I look for strongest industries, and I'm going to explain that in the next step. But I start out with a universe of 5,000 stocks. I only want stocks that are in the strongest industry groups because research shows that they outperform. And I immediately come up with 856 stocks. So I've already filtered out over 4,000 stocks. And then as you see, as I put each of my criteria in, the power gauge, overall power gauge rating has to be at least bullish. And those 3 factors all have to be strong or bullish. And then if you see down here on technicals, I plug in money flow and relative strength, and that's from the classic bull slide we were just looking at. Those were the criteria. They needed to be strong or bullish. And then up till recently, I was looking for small and mid-cap stocks because they were outperforming, and they were the stocks like PEAPACK-GLADSTONE and National Commerce that I'd never heard of, and would have never found had it not been this way. So that's, at this given time, I plugged the small and mid cap in, and I came up with 20 stocks. So I run this screener really every week, but I can go in any day, click on it, and hit screen. And in 10 seconds, I've got a list of stocks that meet my exact criteria on that particular day. So this is how I found National Commerce and PEAPACK-GLADSTONE. As you can see, I've highlighted them here with the yellow arrows, but when I did a screener back in December, and I also wanted to buy right then and there, I didn't want to wait. So I said, I only show me ones that are oversold, meaning that zigzagging indicator is dipping down into that 30 range, and it was a good buying opportunity. And that's when I bought these two stocks. So typically I like to see a stock on a screener for, up to a month or so. It gives me a little bit more confidence in buying that stock. And in this next section, I'm going to run the screener, show you the screener that I ran yesterday as well and what it came up with. But let me explain strong industry groups, because I alluded to that and I screened for that on the stock screener. But the research shows that 50% of a price move is really attributed to the industry that a stock is in. So by going with strong stocks in strong industry groups, you're putting the wind. We say we're putting your wind at your back. Go with the path of least resistance and go with as many chips in your favor as possible. So how do you find them? Well, Zacks research is kind of the industry standard on identifying the 64 industry groups and bucketing each of those 5,000 stocks into one of those groups. What we do with that is we rank them based on the proportion of strong power gauge rated stocks. So you can see here, from going into our industry list view, coal, business products, major banks, investment banks, banks and thrifts. You've heard in the news that banks have all been incredibly strong since the election in November, and this bears that out. So a number of the stocks that I bought, including that PGC and NCOM, were in this bank and thrift industry group. Now I've got the yellow arrow on it showing that today there are 206 bullish rating stocks in that bank and thrift industry group. Well, to go through 206 stocks is a lot of work, wouldn't you agree? But there's an easier way to do it, and that is to use the screener. Because by selecting strong industry groups in the screener, you're only going to get the top 20% industry group. So it automatically takes you to the cream of the crop. So unless you're really, religious about a certain industry group that you want to be in, what I do is just go with the screener, and it'll show me the strongest ones. So this is running the screener back February 2nd, which was about, where are we? March 9th. It's about 5 weeks ago. And you can see I highlighted Progressive, the stock that I've already shown you a stock chart of. So this had been on the screener really for several weeks as of now. And you can see this screener only gave me 5 names. And I did switch over to mid and large cap in February, because they started to outperform the smaller cap stocks. So I switched my criteria to mid and large cap. I got 5 stocks. I got PGR, and I bought PGR. It had been on the screener for a couple of weeks at that time, and I put it on my watch list. I waited till I got this money flow buy signal, which is this triangle I'm pointing to here. You can also see that money flow buy signal, which is up here by this little triangle box here, just happened to correlate to an oversold condition. This stock is under that 30 mark on the overbought, oversold. And of course, everything else is lining up, or it wouldn't have been on the screener in the first place. So I don't have to think about or drill down on the power gauge to see if those 3 factors I like are bullish. I already know it. Otherwise, it wouldn't have been on my screener. So it really cuts through the information overload dilemma really quickly and zeroes in on exactly what I'm looking for. So looking at this chart, can you see the methodology that I went through of looking at how all the green lined up? It was oversold, and I got the buy signal, and you can see that the stock has gone up pretty nicely since I bought it, just a few weeks ago. So is this all making sense? Are you able to look at this chart and say, hey, I could come to that same conclusion? Because it's important that you start thinking that way and thinking that you can do it, because you can. I mean, if I taught myself how to do this in my 60s with no prior experience in anything financial or economic, you guys can do this too. So I want you to leave here at the end of this presentation thinking, I can do this. This isn't as complicated as everyone says it is. And it really doesn't have to be more complicated than this. Okay, oh, great. Yeses, absolutely. Yes, yes. Carrie, thank you. She says you're the best. That's sweet. Thank you so much. All right, Jessica. Yes, Sandy, you give me confidence. And Caps, see, that's fantastic. And Rose, love it. This is fantastic. I'm so excited. Okay, cool. You see, you guys can do it. It's not that difficult, right? Okay, so let's look at the screener that I just ran yesterday. Again, same criteria, strongest industries, mid and large cap, I got 3. So I take a universe of 5,000 stocks, and literally in seconds, I've got 3 stocks to look at. And guess what's still on there? PGR, Progressive. So this has consistently been on my stock screener for several months, which is a really good sign. But there's 2 others, and I can put these into a list, and then I can flip through their charts and see if they are something I'm interested in buying either now or put them on a watch list and buy them later. So let me pause here. How I set up my portfolio. I have a list that I call my stocks, which are the list I own, a list of stocks that I own. And then I keep a separate list called my watch list. And those are stocks, like AXE or FLEX that I could, from this screener, put on a watch list and wait till either I have the right cash or whether everything, including overbought, oversold, lines up, or I get a buy signal. But that's really how I manage my portfolio. So this is drilling down on yesterday's screener. And you can see I've gone now to AXE, one of the 3 stocks that it identified, met all of my criteria. And then, I look at this. I said, do I want to buy this stock right now? Well, the money flow is strong, but I like it to be a little bit stronger. And this isn't quite making the highs it was making. It's kind of gone sideways, as many stocks have. But I think I'm going to wait until that breakout pattern starts forming before I would buy this stock. That's how I would think. So I've alluded to the screener saving enormous amount of time. This was actually written by Cheryl before we even had the screener. And she says there's not enough time in the day to do the work Chaikin puts before me in minutes. I'm wowed. So Cheryl's only more wowed now with the screener, because that is like an enormous time saver. And how many of you have enough time in the day to do everything you want? I mean, when you come to the end of the day and you go, oh, this was a great day. I did everything I wanted to do. There's nothing on my to-do list for tomorrow. Not likely, right? I mean, I say we're in a time-starved economy and that we're all time poor. I don't know anyone who's able to say, oh yeah, I have plenty of time. I need more things to do today. Not likely to hear that. So saving time is really important. Okay, what to avoid? Just as important as knowing what to buy is what to avoid or what to get rid of. And as I said earlier, accepting that you will have losses is part of investing. There is absolutely no way around it. Warren Buffett loses money. I mean, all of the major investors and hedge funds managers that have made millions, they also have lost money as well. So it's just part of the game. But what Chaikin has done for me is to minimize the loss and get me out before something really tanks. And there are signals which are this classic bear pattern that you see here, which is basically the reverse of the classic bull. So let's look at the Wyckoff chart. Again, it does this zigzagging pattern, but instead of bouncing up, it bounces down. And this is typically the way a stock price moves when it's tanking. And it's important to realize this, because then you'll get out of this stock, like up here at this, say what it calls this throwback, as opposed to wait for it to fall down on its face down here. So let's look at Coca-Cola. All right. What do you see? You see a bearish power gauge rating, solid since mid-July, late July. Relative strength is underperforming the S&P. Money, for the most part, has been going out, although it does have some kind of minor life in it of money coming in. And you get these sell signals. So instead of these green triangles, you're getting red triangles, which means sell. So recently, there was this sell signal here, looks like just about a week or so ago, oversold. Okay, so if you didn't have this set up here to look at, and you were just looking at the stock price, you might think, oh wow, this stock is, you know, on an upswing. I better get into this stock. Coca-Cola, it's got to be a good company, right? It's worldwide. I better get into this before it goes up any further, because it's already gone from like 40 to up to what, 42.5 or so. But looking at this, at these indicators here, would you have a different opinion than saying, I think I should get in? Just type in, what do you think of this stock? Is this a stock you'd like to get into right now, or is this a stock that you don't think would be such a good idea to get into? And just, if you will, in your there we go, I'm getting lots of no's. Or Carrie says short it. Absolutely. Yeah, these bearish stocks are great short candidates. Joe, not the right time. Lots of no's. No. And Richard again, sell calls. So yeah, they're great aids to shorting or selling a put option on a stock, or holding off altogether. Or if you were in this stock, when it reaches this oversold condition here, this would be an ideal time to get out of it, because again, it's hitting this upper 70 range on the overbought, oversold, and of course it then will go down. So understanding that Wyckoff pattern, that stocks zigzag up and down, is critical, because you're going to you're going to sell when it's up, when it's peaking up, and you're going to buy it when it waits. And you learn to be patient and wait. Other stocks I want to get in, but they're overbought, and I say, nope, I'm just going to watch this until it zigzags down again. But just as I said before, it's important for you to have your own set of tools and your own research you can depend on. This is what happens if you don't. You go with the news, and you go with, oh, Goldman Sachs, they're a big deal. They're all these investment bankers. There's what, 6 or 7 of them in the cabinet of Trump's administration. They're really considered the smartest guys around. If they're telling me that they've downgraded Coke and Procter & Gamble, that's pretty reliable, right? Well, it might be, but it was on January 9th. Let me remind you, let me go back to this arrow here, it was in late July that the power gauge turned bearish. So that's when you get out of a stock. If you own this stock and the power gauge turns, particularly if you've got negative relative strength, you get out. And you would have gotten out of this stock up at what, 46 or so, and not waited for Goldman Sachs to get you out down here at 41. I mean, that's not much help. So they're 6 months late. So that's why you've got to have your own set of tools that you can depend on. By the way, they downgraded Procter & Gamble, but that stock has gone up significantly since they downgraded it in January. So, you know, so much for the pros, right? Estee Lauder, in a, you know, that cosmetic field that I used to work in, the competitor of Elizabeth Arden and L'Oreal's, and their stock is doing terrible. I mean, look at this right here. And look what happens when there's a lot of money coming out. Look at the significance that reflects in the price. That money flow is so important. I mean, everything else being equal, you get a lot of negative money flow, and that price is going to go down more significantly than, say, before, when everything was kind of even here. But I point out at the bottom the articles. There's one article saying, "Is it time to sell?" from Zacks. There's another article on the same day, or yeah, within a day of it, saying Piper Jaffe, an analyst, thinks that it's going to go up. Time to run. So this is the problem. You know, you get one analyst saying sell, you get one analyst saying buy. Who do you believe? Well, I think looking at this chart, you'd believe the sell, particularly today when you get a relative strength sell signal on this stock. You'd be out of the stock, but you would have been out of the stock back here in May when the power gauge turned negative, and that was up at around, what does it look like, around 92 or something, and it's now 82. So, you know, that's why it's critical to have your own tools that you can depend on. John Malden, who's another financial expert and partner of ours, is very impressed by the power gauge rating, and he uses the system, as he says here, integrated into his routine due diligence. Boy, that's a tongue twister. Process for vetting and evaluating potential investments. So our partners have noticed our success with the power gauge rating and have come to rely on it as well. All right, this is the $50 million question, knowing when to buy. Oh, shoot, let me go back here. Sensitive mouse. Okay, when to buy. So I've been referencing the buy and sell signals, as you can see in the panel on the left. I'm not going to go in any more detail other than to say that there are descriptions of when they trigger in our kind of handbook on the website. And I use those buy-sell signals in addition to the oversold indicator that I've been pointing out as well. So how do you find them, though? I mean, how do you know, other than just flipping through your stocks and seeing that there is a sell signal or a buy signal on it? Well, we've made it easy by creating what we call an alerts view. And this alerts view, as you can see, I took my stock list here. I went to the little bell, which is the alerts view. And today there was only one signal, one buy signal that triggered. And it's on the stock that I own, National Commerce, oversold. And as you can see on the far right with the arrow, that's the oversold buy that triggered today. And you can see that it correlates down at the bottom to the 30. You see how that on the overbought, oversold squiggly line here, it's zigging down. And that's what this correlates to. So if I were to take a second position in the stock, now would be a good time for me to say, yeah, I'll take the second position now. But everything else is green and go. Part of my kind of due diligence, my 10 to 15 minutes a day that I spend, is to use this overlay on my stock list And then it also will indicate other things that may affect the price of a stock, like a power gauge rating changed. If something on my list goes from, say, bullish to neutral, it points that out in this alerts view for me. It also tells me if analysts or estimates have changed, and analyst estimate opinions have a big sway over price moves as well. So anything important like that that can affect the price of my stock, it alerts me to, which is pretty cool. I also overlay this on my watch list. So I told you I keep 2 lists. I do this alerts view every morning and every night because after the close, the power gauge ratings are updated, signals are updated, and I flip through them after the close. And on my watch list, you can see there's a lot more buy signals. There's actually 18 in total, and I've highlighted the EEFT and shown you the stock chart for this. It's a financial stock, bullish power gauge rating, and you can see that it also triggered an oversold buy. So it's saying, Sandy, if you're considering buying this stock, now is a good time because it's at that 30 mark. And look at the money coming into that stock. That's what I love to see. For me to buy this stock, though, I'd wait for the relative strength to turn greener. I want to see that healthier because right now it's kind of neutral. So I can be really picky buying a stock, and that's okay. That's why I keep a watch list. You know, and when everything meets my criteria, and I have the cash because I've sold something else, you know, then I've got a short list of stocks to buy. All right, knowing when to sell. You know, this is really the Achilles heel for most investors. I think it's a lot easier to buy a stock than to sell, don't you think? I mean, I'm a shopper, so I like to shop. So I like to shop for stocks. I think it's a lot of fun. But I think the Achilles heel of most investors is when to sell. Keep this in mind. What I do. There's two times when I'm selling. Either I take it to profit, or I'm sensing a breakdown. And let's break those down. And this is really the important steps. I know I save it for last, but this is being recorded. If you have to jump, you will get the recording tomorrow, and you can listen to this part tomorrow. But this is really the critical part of investing that will really separate the winners from the losers. But taking a profit meets one of these three, or all of these three criteria. The price hits the upper volatility band, and I'll show that to you on the next slide. The price is overbought. That's that zigzag line that goes up to the 70 mark. Or a price spikes after strong earnings reports. If analysts come out strongly on a stock and they report, if they have a really good earnings report, that stock can spike up 10-15%, and you can take a very quick profit. I don't have time to go through that today, but you can see how that's happened actually here. These EPS is when a stock is reported. You can see it reported, and look at this. They obviously beat the analyst estimates and guided higher, and the stock jumped up from what, 14 to what it looks like 17 and a half or so. You know, then you can, if you own that stock, if you own that stock, this would have been a good time to sell it up here. Okay, so I bought this stock after that earnings report when it pulled back. It was on my watch list. It correlated to this 30 dip on the overbought, oversold. Everything else was equal. This was on a screener for several weeks, so I felt confident buying. I got in here at about, I think, 16. And then look what happens. You know, this is the volatility band, and this, I think of this as a channel. I'm a sailor, and I know there's certain rules to sailing. And if you get outside the channel, there's a strong possibility you could run aground, and that's not good. And it's the same with the stock volatility channels. These keep you in the game. it's typically it mirrors where the price range is headed. But if it bumps up against this upper volatility band, there's a very strong possibility that it's going to come back down, that's the highest it's going to go. You can see here, it did go outside of it for a week or so here, but then it pulled back. So the time to take your profit is when it hits that upper volatility band. And that's what I did here. The price, for some reason, and I never could find any article about it, but for some reason, it spiked up 6% when the day I sold it, which was February 13th. And I thought, oh, wow, it spiked up 6% in one day. It's hitting this upper volatility band. I think I'm just going to take my profit and be happy. And you can see that money flow had just turned negative. Relative strength power gauge was still strong at that time, but money flow was starting to turn. It was just ticking negative. And you know how I depend on money flow, and I love money flow as a kind of a precursor of what's to come. So I said, I'm getting out of I'm leaving the party. It's been great. I made a nice profit. And I sold up here and took my profit. Well, the next day, they pre-reported their earnings, which is really strange because I've rarely seen that happen. And they said, "Gee, we're not going to come out with a very good earnings report." so the stock took a dive, and you can see what happened. It dropped 10% here. It kept going down. They did come out with a disappointing earnings report. It dropped another 6%. And it's now at 15. Well, I sold this. I mean, it's below what I bought it at, and I sold it up here at, where did I sell it? I think it was about 18.5. So that was great. I was able to take a really nice profit on this stock. I took a 17% profit in a couple of months, and I avoided the pain of watching the stock go down because I wasn't greedy and looking to eke out more. But when that money flow turned, I said, I'm going to take advantage and get out now. Similar thing happened here with another stock that I owned. Again, I bought it on a pullback. Again, this was on a screener. So I was just watching it, waiting for the right time. It pulled back. I could have sold it up here. I was out of town, actually, in California, and I wasn't really following my stocks that one day when it spiked up there, and I saw it the next day, and I thought, oh, damn, I should have looked at it yesterday and sold it. But I had another opportunity here when it hit the upper volatility band just last week or so, and so I sold it up here. And and again, the reason I sold it, hitting the up money flow is starting to turn negative here. So that's the discipline, and by following this discipline, I've really been able to avoid a lot of pain. I dropped down this one-day chart here so you can see when you're considering selling a stock, you can watch it or buying a stock and see the activity minute by minute. And this is really helpful when you're making that decision too. All right, so Anil, who is probably on tonight's webinar. Hi, Anil. He's a great follower of Chaikin, been a subscriber for a couple of years, and he teaches the stock market class in an adult education program as part of the University of Delaware. And I went out there in the fall and spoke to his class of some 200 students. And it was really exciting. And I went over these rules, and Anil got back to me in January, and he said, I followed your sell rules, and I sold EME at the 52 weeks high, took a 23% profit. He says, my rules are more complex, but I'm going to follow yours in a test portfolio. So in January and February, I got back to Anil. I said, Anil, what's happening with this test portfolio? And he gave me the examples here, which you see in the bottom right, of the percentages that he's realized. The last one, AXS, he sent me an email yesterday. with that performance. So it's following that fixed methodology. It's unbiased. There's no emotion to it. It's not like, oh, should I, or shouldn't I? Maybe no, I don't know. Maybe it's going to go up. I mean, if you use these rules basically and think of them as rules and think of them objectively, they'll keep you out of trouble. They certainly have helped me, and they've helped Anil as well. All right, the other scenario when I sell is when I can see a stock breaking down. So let's look at a couple examples of this as well. All right, Quad Graphics. That was one of the winners of last year. That stock was up 189% last year. Small cap stock, probably one no one's ever heard of. I certainly hadn't. Great stock last year. But this year it's not doing so well. It's down 4% so far, and the S&P 500 is up 6%. So that's not so good. But let's break this down as to why I knew to get out, or when I knew to get out. All right, so I bought it back here in June. Remember the Brexit vote, June 24th. And after they voted and Great Britain voted to pull out of the European Union, the market, for the most part, pulled back 5%, 5 to 7%. I used that as a buying opportunity. I had a screener that I had pulled. I had cash, and I said, oh boy, this is a great time. And I bought a number of stocks on that pullback, that 5% pullback. And this one gave me a momentum breakout. And as you can see, it was also oversold when I bought it back here on June 24th. So the stock went up and then started going sideways. You can see what happened. Money flow started to come out. Relative strength, kind of neutral, and a neutral power gauge rating. So I was just looking at the right time to get out of this stock, and it kind of crossed over this 200-day moving average, which is this orange line here. And I thought this is a good time to get out. So I got out here in November, right before the election. And I took my profit and was glad to be out. So just because a stock does well in 1 year, it doesn't mean it's going to hold that value going into the next year or month or whatever. And you can see what happens now. It triggered a relative strength breakdown today. So if I hadn't already been out, I certainly would have been out when I saw that sell signal today. But this is really how you can save a lot of pain, by just following these simple rules, totally unemotional. And you'll find winning stocks and avoid losing stocks. So let's recap the 5 steps. The tools you trust, we base that on the Chaikin power gauge rating. Knowing what to buy, that's the classic bull. Buying the strong stocks in strong industry groups and let the screener do that research for you, unless you're keen on a certain industry group. Knowing what to avoid, that's the classic bear. And knowing when to buy and sell, which is using those buy-sell signals, the overbought, oversold, and then those simple rules that I've just been through as to when I sell. So I made a promise to you earlier on that you would discover my secret to beating the pros, so that you can quickly and easily find winning stocks. So I hope I've delivered on that promise. But also what's fun to do, and I really have made investing fun. It's something I used to absolutely fear. And now it's fun. And I love talking about it, and I love teaching it, and I love sharing my experience so that other people can, investors like you, can see it as fun as well. But think about where you want to spend some of those profits you're making. You certainly want to put some away towards your retirement plan, but think about also, what you'd like to use some of that money for. For us, it's vacations. One of our vacations was to Turkey. Steve Godwin is a good friend of ours, and his daughter was getting married in Istanbul a couple of years ago. Thank goodness it was a couple of years ago. We certainly wouldn't be going there now. But he says, you two are the dream team, genius of Mark to create this functional system, and the brilliance of Sandy to learn the stuff and present it with such frankness, simplicity, and genuine caring. I think I can learn this amazing thing too. So I love this because that's exactly what I want you all to be saying to yourself. I think I can learn this amazing thing too. And you can, you really can. If I can do it, you can do it, believe me. So this is all powered by Chaikin. The platform, I'm going to make you a special offer. So just hang on, because we want you to get in as a Chaikin user and start benefiting from using these tools yourself so that you can find winning stocks and avoid the losers. The platform comes bundled with the screener. There's a whole options overlay that we haven't had time to go into. There's the earnings alerts, which again, we haven't gone into. I've only really touched on a piece of it. And there's a new stock discovery engine as well, which you can seed with any stock, as I seeded here, just with a click of the mouse. I put progressive, and it's showing me stocks that are like it. In other words, stocks that are insurance, large cap, have strong free cash flow, and at or near a new high. And those are the stocks here. You can click on any of these stocks to get their stock charts. It also gives you other options, similar short candidates or similar bulls. So you can use this stock discovery engine to find ideas for long trades as well as short trades. But this is a really handy tool as well, in addition to the screener as a stock idea generator. So I told you we'd be making you a special offer for Chaikin Analytics so that you can use these tools to make winning trades. It's usually $1,950 a year. We're taking $200 off. We're bundling all these additional things into it. There's the stock discovery, the options. You get Mark's weekly market insights letter, which has specific stock ideas and his outlook on the market. It's really valuable. You get coaching calls. I've highlighted those in red because I feel those are really critical to success, to know how to use the system. Because if you're not confident about how to use it, how to create your list, how to use those drop-down menus to break down the Chaikin Power Gauge rating, for example, you're not going to have the success that you could. So we want to make sure you know how to use this. So as early as tomorrow, you'll be on a coaching call. Well, Joe or someone on his team will walk you through the system and how to use it, how to set it up. And if you need more coaching, you are welcome to schedule a one-on-one. I don't know any financial service company that will set up a one-on-one appointment for you to talk to Joe or someone on his team to help you guide you how to use Chaikin to meet your specific methodology. And then we have these what we call insiders communities. These are these open forum subscriber only sessions we have every other week to talk you. Our chief market strategist is on to highlight what's happening in the market, and we also highlight new features like stock discovery and how to use them. So it's more coaching. Additional stuff that comes with the subscription. And now I'm going to take an additional $100 off. So for $1,650, you can become a Chaikin subscriber when you subscribe by midnight tonight. So we want to reward you for taking action now and taking advantage of the special offer of $300 off, but it's only valid till midnight tonight to get that extra 100 off. So Joe, I'm going to turn this back to you at this point, and thank you all for attending tonight's session. I hope it was valuable, and I want you all to be fearless investors and to say, I can do this too.
Awesome. All right, Sandy, thank you so much. Thank you all very much for joining us for today's webinar. As Sandy mentioned, we will be here tomorrow afternoon for one more webinar. This is a webinar that we'll be doing just for our own subscribers, the onboard session, just as Sandy mentioned. Whenever we host these on Thursdays, I always say there's no better time to join Chaikin Analytics than with Sandy's discounted offer, $300 to make your subscription $1,650 for a full year to Chaikin. But then to also join us for our onboard sessions. So this will be a great way. I saw a lot of you guys asking questions about how do I identify entry points, exit points. There were questions about the screener, how to set up your own list within Chaikin Analytics. All of that is covered during our 2 o'clock onboard sessions. That'll be Eastern time tomorrow. I just sent out a link, by the way, in the chat room. Hopefully this is blinking for you right now. It'll just include a link, chaikinanalytics.com/Sandy, as well as if you want to give us a phone call, 877-697-6783, and you'll be able to get in touch with us directly. If you do go to the website, chaikinanalytics.com/Sandy, you will see the discount automatically applied. So we do hope you'll take advantage of this. We'd love to see you on the webinar tomorrow afternoon at 2 o'clock Eastern time. In the meantime, everyone, have a great evening and have a great evening, and we'll see you tomorrow afternoon. Thanks.